Hey everyone, welcome back to where we break down the latest trends in business and finance with a dash of humor. Today, we're diving into the mind of one of the greatest investors of all time, Warren Buffett. Known as the Oracle of Omaha, Warren Buffett has amassed a fortune by following a few core investing principles. We're talking billions and billions of dollars, folks. And the craziest part? His strategies aren't some super secret exclusive thing. They're actually pretty straightforward, so whether you're a seasoned investor or just starting out, stick around as we explore you might be surprised at how simple yet powerful they really are. Let's get into it. Warren Buffett is all about sticking to what you know. This isn't about picking the hottest stock tip you heard from your Uncle Larry. It's about understanding the businesses you're investing in. If you can't explain how a company makes money to your grandma in 2 minutes, don't invest in it. It's got to be clear and understandable. Buffett avoided tech stocks during the dot-com boom because he didn't understand them. And guess what? He was right. Many of those companies went bust, while he thrived with simple investments. Stay within your circle of competence. Stick with what you know, and you'll be ahead of the game. You don't need to be an expert in everything, just in the companies you choose to invest in. Do your research, understand the business model, and make sure it makes sense to you. If you're unsure, ask for help. Talk to a financial advisor or move on to a company you understand better. All right, let's talk about Buffett's favorite holding period. Ready for it? It's forever. Okay, maybe not literally forever, but you get the idea. Buffett believes in buying solid companies and holding on to them as long as they perform well. This isn't about day trading or timing the market. It's about finding rockstar companies built to last. Think about it. When you buy a house, you don't plan on selling it next week, right? You see it as a long-term investment. That's the mindset Buffett brings to the stock market. Of course, forever is a long time, but the point is, don't jump in and out of the market on a whim. Don't let your emotions get the best of you. Instead, focus on finding companies with strong fundamentals and a bright future. Those are the ones you want to hold on to for the long haul. Remember, Rome wasn't built in a day, and neither are massive fortunes. Be patient, stay invested, and let the power of compounding work its magic. Now let's talk about the moat strategy. No, we're not talking about castles and knights here, though the principle is similar. In investing, a moat refers to a company's competitive advantage. It's that special something that protects them from their rivals and keeps them ahead of the game. Think about Apple's incredible ecosystem, or Coca-Cola's brand recognition that's practically imprinted in our brains. These are moats. They're what make these companies resilient and profitable over the long term. Buffett loves companies that can fend off the competition, those that have a clear edge in the market. And you know what? It makes perfect sense. Why invest in a company that's constantly struggling to stay afloat when you can invest in one that's practically untouchable? So, when you're researching companies, ask yourself, what makes this company unique? What sets them apart from the competition? What's their moat? If you can identify a strong, durable moat, you might just be onto a winning investment. Chapter 4. Don't try to time the market. All right, let's talk about one of the biggest mistakes investors make, trying to time the market. Here's the truth, folks. Timing the market is like trying to predict the future. It's a fool's game. Even the so-called experts get it wrong all the time. The market is unpredictable, and trying to perfectly time your entry and exit points is a recipe for stress and often disappointment. Instead of trying to be a fortune teller, Buffett recommends focusing on the quality of your investments. Find those solid companies with strong fundamentals, a good track record, and a bright future. Those are the companies that will weather the market storms and come out on top in the long run. Remember, time in the market is more important than timing the market. So instead of trying to predict the unpredictable, focus on building a diversified portfolio of great companies and let the power of compounding do its thing. Chapter 5. Diversify, but don't overdo it. Now let's talk about diversification. You've probably heard the saying, don't put all your eggs in one basket. Well, in the world of investing, diversification is key. But here's the thing. Buffett warns against spreading yourself too thin. Having a little bit of money in a ton of different stocks might sound good in theory, but it can actually hurt your returns. Think about it. If you own a tiny slice of 100 different companies, you're not really invested in any of them. You're just along for the ride, hoping for the best. Instead of going for quantity, Buffett prefers quality. He believes in concentrating your investments in a handful of strong, well-researched companies that you truly believe in. Remember, diversification is about managing risk, but it's also about maximizing returns. So find that sweet spot, a diversified portfolio of companies you understand and believe in, and watch your investments grow. Chapter 6. Be fearful when others are greedy, and greedy when others are fearful. Now, for one of Warren Buffett's most famous quotes, be fearful when others are greedy, and greedy when others are fearful. It's a simple statement, but it holds a powerful message. This is all about going against the crowd, about thinking independently and not getting caught up in the hype. When everyone else is panicking and selling their stocks for pennies on the dollar, that's when opportunities arise. Think about it, when a store has a massive sale, do you run away screaming? No, you grab your wallet and stock up on those amazing deals. The same principle applies to the stock market. On the flip side, when everyone is overly optimistic and throwing money at every hot stock, it might be time to step back and reassess. Remember, the market is driven by emotions, fear, and greed. By understanding these emotions and learning to control your own, you can make smarter investment decisions and potentially profit from the mistakes of others. All right, let's talk about value investing, a strategy that's near and dear to Warren Buffett's heart. Value investing is all about finding those hidden gems in the market stocks that are undervalued compared to their intrinsic worth. Think of it like finding a $100 bill lying on the sidewalk. Sure, it might take some digging and searching, but the reward is well worth the effort. Value investing requires patience, discipline, and a keen eye for opportunity. You need to be willing to do your research, analyze financial statements, and identify companies that the market has overlooked or mispriced. But here's the beauty of it. When you find these diamonds in the rough, the potential returns can be substantial. Because you're not paying a premium for hype or speculation, you're buying a company for less than it's actually worth. Remember, value investing isn't about getting rich quick. It's about taking a long-term perspective, identifying undervalued assets, and letting the power of compounding work its magic. Now, even though Warren Buffett is a huge fan of the stock market, he also understands the importance of having cash on hand. That's right, even the Oracle of Omaha knows that cash is king. Having a healthy cash reserve gives you flexibility and peace of mind. It allows you to pounce on opportunities when they arise, whether it's a market downturn or a once-in-a-lifetime investment opportunity. Think of it like having an emergency fund for your portfolio. You never know when you might need it, but you'll be glad you have it when you do. So, how much cash should you keep on hand? Well, it depends on your individual circumstances, risk tolerance, and investment goals. But as a general rule of thumb, it's always a good idea to have at least a few months' worth of living expenses in a safe and liquid account. Remember, cash isn't just about playing it safe. It's about being prepared for anything and having the financial freedom to make smart investment decisions when the time is right. Now, before you even think about putting your hard-earned money into the stock market, Warren Buffett has some sage advice. Invest in yourself first. That's right, folks. You are your greatest asset. By investing in your education, skills, and personal growth, you're setting yourself up for long-term success, both financially and personally. Think about it. The more you learn, the more you earn. By acquiring new skills, expanding your knowledge base, and becoming a more well-rounded individual, you're increasing your earning potential and opening up a world of opportunities. And the best part? The returns on self-investment are practically guaranteed. Unlike the stock market, where your returns can fluctuate, the knowledge and skills you acquire will stay with you for a lifetime. Remember, investing in yourself is the best investment you can make. It's an investment that will pay dividends for years to come. And finally, we come to the most important investing strategy of all: patience. If there's one thing Warren Buffett embodies, it's the art of waiting. In a world of instant gratification and get-rich-quick schemes, it's easy to forget that true wealth is built over time, not overnight. The stock market is a marathon, not a sprint, and patience is your greatest ally. Remember, Rome wasn't built in a day, and neither are massive fortunes. The best returns often come after years, not months of patient investing. So don't get discouraged if you don't see immediate results. Instead, focus on the long game. Stay invested, ride out the market fluctuations, and let compound interest work its magic. As Warren Buffett famously said, someone's sitting in the shade today because someone planted a tree a long time ago. So be that someone, plant your investment seeds today, nurture them with patience and discipline, and watch your wealth grow over time. And there you have it, the top 10 investing strategies of Warren Buffett. Remember, these strategies aren't about getting rich quick. They're about building wealth steadily and sustainably. Just like Buffett, you can use these strategies to make smart investment decisions, weather the market storms, and come out ahead in the long run. So, what are you waiting for? Start investing in yourself and your future today. If you found this video helpful, don't forget to hit the like button, subscribe, and ring that notification bell for more content on the latest business trends. And as always, keep it classy, keep it smart, and I'll see you in the next video.